Hello, welcome back to my accounting video tutorial. Now today I'll be taking you through what we call as financing an asset. Basically, I'll explain to you some methods in which a business can finance its assets. Basically, we're asking the question, how can a business finance its long-term assets? Now again, what I mean by that is in how many ways can a business purchase or have assets in its accounting books. Well, let's go back to the start and ask ourselves now. We've got a small business, a proprietary limited company, and the business has one director who's a business owner, and he also happens to be the shareholder of the business. Now, you need to first of all introduce funds into the business. So how can funds be introduced to the business? Well, you start with a cash account. So let's say you start with a cash account of $100,000. How is that brought into the business? Well, the first and simplest way is from the director himself or the shareholder. Now, if the director is also the shareholder, you can introduce the money into the business in one of two ways, or a mix of both ways. So one way is through shareholders equity, where the shareholder has put in capital, and that is included as part of the equity of the business. It's not a liability. It's not a long-term liability. But it's equity. It's an investment that the shareholder makes in the business, and at the same time expecting a return on that investment. So in measuring the return on that investment in a previous video, we spoke about return on equity. So the profit that the company generates is in terms of a percentage against the total equity of the business, in simple terms. So the director can put in $100,000 in the business, and it's called equity or shareholders capital. Or because it's a one-person business and it's a small business, it can be put in by way of what we call a director's loan, which is a long-term liability or a non-current liability. So that means the company is expected to pay that $100,000 to the director at some point after 12 months. So it's not a current liability, it's a non-current liability. The director can also choose to do a mix. So the director can put in $50,000 and that can be called a non-current liability director's loan, in which the company owes money to the director. And on the other hand, another $50,000 as a shareholder's contribution that goes into the equity section of the business. So the director can fund the business by debt and equity. And you can use any particular amount of dollars as a debt to equity proportion. You can put it all in debt in a liability. You can put it all in equity. It doesn't matter whichever way you go. Now, having brought funds into the business, we now bring some assets into the business. So in the balance sheet of the business, there's what we call current assets and non-current assets. And under the non-current assets, you have property, plant, and equipment. These are your assets that are providing the business with an economic benefit over a period of longer than 12 months and is expected to, say, for example, have a useful life of, let's say, 10 years, maybe 15. And throughout the life of this asset, the company generates income and profits. So that's what's expected out of a non-current asset. So I'm going to do another little exercise with you. So this exercise is about financing an asset. So let's take a small business here, Chelsea Transport Pty Ltd. Now, this business purchased medium-sized trucks. It's got it's a commercial vehicle, so it's not designed to carry any passengers. Now, the business is also eligible for the small business tax concessions as per the ATO provisions, including the instant write-offs and accelerated depreciation provisions. So let's say the company purchased two medium-sized trucks. It's in the transport industry, it delivers goods and so on. So it bought trucks costing a total of $100,000. So we put this in the cost. Now, we're not worrying about shipping and anything like that for now. Let's just say the $100,000 is including all the shipping and all the additional costs. GST is $10,000, 10% extra on top of the $100,000. And then the total overall that the business has to outlay is $110,000. The trucks are expected to be used in the business for at least 10 years. Now, according to normal accounting depreciation provisions, you can use two main methods. Prime cost, which means you take the cost of the trucks at $100,000 and you divide it by the useful life, which is 10 years. We're not going to assume any residual value or anything like that. It's just a very simple, straight exercise. So in this case, if the prime cost method of depreciation is used, we then can claim $10,000 as a accounting depreciation expense. And then the other side of the $10,000 is accumulated depreciation of vehicles. It's basically what you have learned at university or what you are learning at university. The diminishing value method can be double of the prime cost. So if the prime cost method depreciation is $10,000, under the diminishing value method, you can depreciate in the first year the vehicles at $20,000, which means then the written down value will be $80,000. And if you're using the diminishing value method, the depreciation claims each and every year after the first year is based on the written down value and not the cost value. The prime cost is always based on a straight line method based on the cost value of the car. Now, how many different ways can this business purchase the vehicle? Well, one way, and the simplest of way, is it can use its cash that's been invested by the director to purchase these vehicles. And so if it uses cash, the journal entry that we take is we debit the vehicles, which is an asset. How much are we going to debit that? $100,000. Because there's a GST component that needs to be taken into account where we need to record it as GST receivable. So we need to debit GST receivable, $10,000, and then we credit cash or bank account, $110,000. So that's your entry. You're recording the vehicles as an asset at the start, and then you're claiming GST on that, and you're reducing your bank account. Now, because the business is also eligible to use the small business tax concessions, the taxman has stated that, well, not the taxman, but according to the federal budget, and then it was passed as law, that you have until 30 June 2021 to take advantage of the instant asset write-offs up to $150,000 per asset. So if this truck cost $150,000, the business can instantly write it off. Now, when you instantly write it off, bear in mind you cannot claim depreciation in the years to follow because you've instantly written it off, you've taken a taxation benefit, and who knows, perhaps that taxation benefit has then led the business return in a tax loss position. Now, that's fine because you've used the taxation law provisions for that. So suppose a business can choose to use the instant write-off method and it can use it in its accounting records. We're saying that the business is not a reporting entity and the accounts or the financial report of the business is not audited. So it can use the taxation laws in its accounting records if it wants to tie in all the figures and reconcile its accounting records with its taxation records. So in doing so, we can create an account called asset write-offs, which is an expense account. You debit $100,000. Why $100,000? Because GST is, it's not assessable and not exempt. GST is what the business is claiming on the price of the asset. And so GST is not counted when you're allocating or recording a particular item as an asset or an expense. In fact, the GST component is taken off the total purchase component or the total expense outlaid. And then you credit the vehicles, the asset, at $100,000. So that way, at 30th of June 2021, in a profit and loss, there will be an instant write-off amount of $100,000, and there will not be any asset or any vehicles in the asset section because the business has used the taxation provisions. If the business was to use the accounting depreciation method, it can use a diminishing value method. So in this case, we've already explained the depreciation expense in the first year is $20,000. Now, let's assume that the business did purchase their vehicles on the 1st of July 2020. So for the whole year, so for the year ended 30 June 2021, we record depreciation expense, $20,000, and vehicles accumulated depreciation, $20,000. Now, accumulated depreciation, as you would have learned from university or you are learning at university, is a contra account to the asset account. You never credit the asset account itself when doing the depreciation entry. You always leave the asset at its cost price, at historical cost, and you then create a accumulated depreciation account. So that's using the diminishing value method of depreciation. And so the written down value at the end of year one will be $80,000. And as explained before, if you're using the diminishing value method of depreciation, in year two, you then use 20% of $80,000 and not $100,000. Diminishing value is always worked out at the written down value of the asset. Now, what that does is it gives you a greater claim or a greater deduction in your first 2 or 3, perhaps 3 years, and then the depreciation expense reduces and reduces until it gets actually a bit lower than the prime cost. Whereas a prime cost method of depreciation gives you exactly the same claim every year in a straight line, and therefore there's the depreciation is always worked out on the cost of the asset. Now, there's other ways of financing the asset. So let's say Chelsea Transport wanted to look at other avenues of financing their vehicles. One way of doing this is by a finance lease or operating lease or whatever you want to call it, a lease. Now, a lease can be seen to be a good thing depending on the needs and requirements of your business. However, in the event of a lease agreement, the business is not the rightful owner of the asset, but it can own the asset after all of the lease payments are finished, and the business will then have to make a what we call a balloon payment to purchase the asset. So in a lease, there's a couple of advantages and a couple of disadvantages. One disadvantage perhaps is that the business cannot claim the asset as an outright deduction, and depreciation cannot be claimed because the business is not the rightful owner throughout the term of the lease agreement. And so the financier is the rightful and legal owner. Also, the $10,000 GST, unfortunately, cannot be claimed outright upfront because of the lease contract. Now, the lease agreement, it will include the term of the lease, how many number of years the lease is, the interest percentage, the principal payment, and the GST amount for each month. So the principal and the principal payment doesn't change, but the interest is amortized over the term of the lease. So the interest keeps reducing each payment that you make in relation to the lease. So what the journal entry looks like is you debit a lease expense. You then debit the interest expense component. You then debit GST receivable. So GST receivable is an asset in the balance sheet. It's the GST component of the lease payments that you're claiming every month. And you credit your cash or your bank account. So the lease payments are the same each month, but interest reduces. And the more payments that are being made month by month, the interest is going to be reduced. So that's basically the idea of a lease. Now, if this business was a reporting entity, this journal entry would be done in a different way in accordance with the accounting standard on leases, but that's not going to be discussed in this tutorial. The other way of financing these vehicles is through a hire purchase agreement. Now, you may say, well, a lease and a hire purchase are the same thing, right? Well, not exactly. The hire purchase agreement states that the business enters an agreement to hire the vehicles and is the rightful owner. However, still the financier is the legal owner of these vehicles or the assets. Under a hire purchase agreement, the business will have an obligation or a right to purchase the asset at the end of the term. So the business will have the obligation to pay some sort of amount to purchase the asset and be the legal and rightful owner of the asset. In a hire purchase, the business is the rightful owner of the asset, but not the legal owner. Now, the business can claim the tax deduction on the vehicles, assuming it's a small business entity and it does qualify for the tax write-offs. It can instantly write off the vehicle as an expense. However, the hire purchase itself must be shown in the balance sheet and is to be separated between a current liability and a non-current liability. Now, your accountant will provide or will prepare a hire purchase schedule where it will split between what's current and what's non-current so that you can clearly see it in the balance sheet. So in the balance sheet, you will see under current liabilities, hire purchase, payments that are expected to be made within 12 months. And then in the non-current liabilities, another hire purchase liability, that which payments are expected to be made after 12 months or beyond 12 months. Now, the journal entry to record the vehicles under a hire purchase agreement is you debit the vehicle asset, or you can choose to debit the asset write-off, which is an expense item. You debit $100,000. GST receivable, you can claim upfront in a hire purchase agreement. So you debit $10,000 and then you credit initially the hire purchase liability. In this case, the liability is $110,000. Now, the hire purchase agreement will also have a term of X number of years and the interest rate. In fact, in a hire purchase agreement, the interest rate is usually lower than in a lease agreement. So bear that in mind as well when deciding between the hire purchase and a lease. Now, then each month when you record the hire purchase payments, there's journal entries that need to be done. So you debit the hire purchase charges or interest expense. So the interest component of the hire purchase is deductible. So not the whole amount of the payment, unlike the lease, you cannot claim the whole amount of the hire purchase as a deduction. You can only claim the interest component. Then you debit the hire purchase liability repayment. which then reduces your liability each month, and then you credit your cash or bank account. Then the third way of financing is by a chattel mortgage or a bank loan. So this is again similar in ways to a hire purchase agreement. The accounting concept of the mortgage or loan is similar, but with the loan, the vehicle will no longer be under a mortgage, and there's no payout at the end of the loan term. So after you pay off the loan or the chattel mortgage or whatever you want to call it, you are the legal owner of the asset, and there is no payout amount, or there is no balloon payment or anything like that. So it's yours without making any extra or additional payments. So the journal entry to record the loan, again, you debit the vehicle asset or an instant write-off, because again, under a loan, you are the rightful owner, or the business is a rightful owner, and therefore can still claim the deductions, can claim the instant write-off or the depreciation deduction each year on the vehicles, and can claim the GST upfront as well. So we debit the GST receivable of $10,000, and we credit a chattel mortgage account or vehicle loan liability or bank loan, whichever loan account you want to call it, but it's a loan. And the loan, bear in mind, with a chattel mortgage or a bank loan, it is a non-current liability. And the requirement, well, it's not, the business is not required to split this liability between a current and a non-current liability, like with a hire purchase liability. So they're just some little differences between a hire purchase and a chattel mortgage or a bank loan. Now, in all of these different ways of financing your asset or the vehicles, the business can claim the running costs, for example, fuel, oil, registration, insurance, and can rightfully claim the GST component on all of the running costs. However, with a finance lease, the financier is the rightful owner and the legal owner of the asset. Your business is just paying lease expense. You cannot claim a deduction on the vehicle, and you cannot claim any depreciation on the vehicle or on the assets in question that's under a lease. However, you can claim the lease expense and the GST components each month when you make the lease payments. Under a hire purchase and a chattel mortgage agreement, you can only claim the interest component of the repayments. And that way, when you make the repayments each month, the liability reduces. Now, under a hire purchase and chattel mortgage, yes, your business can claim upfront deductions on the vehicle itself, can use the tax write-off provisions, or can claim the depreciation amounts each year, and can claim the GST upfront. However, the repayments cannot be claimed. Unlike the lease, the repayments of the loan or the hire purchase cannot be claimed. Only the interest components can be claimed. So in a chattel mortgage or bank loan, then each month, the entry that needs to be done is similar to that of the hire purchase. We debit the loan repayment liability or chattel mortgage repayment liability. We debit the interest expense, the component of the interest each month. And again, interest in respect of a loan or a chattel mortgage is amortized throughout the term of the loan. So the interest again is less after each payment that you make each month. So you debit the interest expense, you debit the mortgage liability or the bank loan liability, and you credit the cash or the bank account. So they're the different ways in which a business can finance its assets. Again, I would please kindly say that this is not a substitute for financial advice of any type or nature. It's only educational. So if you do require financial advice, or if you do require specific advice that's tailored to your own business circumstances, you can feel free to contact me. I'll be happy to make an appointment with you in the office. I do work as an accountant, but I just do not provide any sort of financial advice online. You can contact your existing accountant or tax agent for specific advice tailored to your own needs and circumstances. So I trust that this education exercise has been enlightening, and that you now are aware that there are some methods in which your business can finance its assets. And at the same time, there are also some ways in which the director can introduce cash into the business.